Hello friends, welcome to a new episode of Drishti IAS Editorial Analysis. In this editorial analysis, we do three things. First of all, we link the editorial to the UPSC Civil Services exam syllabus. Secondly, we try to understand the key points mentioned in the editorial. Thirdly, if any important concept has come in the editorial and is important from exam point of view, we also discuss that. So let us begin today's editorial analysis. The editorial has been taken from the Hindu and it has appeared on 29th of April. The title of the editorial is Signaling Support, and it says that RBI's liquidity facility for mutual funds still hinges on banks' willingness to lend. So basically it is saying that the liquidity facility that has been announced by the RBI will be effective only if the banks come forward to lend to the mutual funds. It links both with GS paper 2 and GS paper 3. GS paper 2 because it talks about RBI, which is a statutory body, and because mutual funds industry is also coming in the picture and it is a part of the capital markets, which is an important sector of the Indian economy, so it deals with GS paper 3 as well. Now let us look at the key points. The editorial starts by saying that the RBI's liquidity facility for mutual funds of rupees 50,000 crores still depends on banks' willingness to lend to the sector. So it is one thing that the RBI has announced that rupees 50,000 crore is available for the banks to lend to the mutual fund industry. But whether the banks are having this risk appetite to lend to the mutual fund industry, there is a big question mark over that. It further says that RBI's decision to open a special facility of this rupees 50,000 crores to ensure the availability of adequate liquidity for the mutual fund industry is timely. And it also adds that it acts as a signal to the investors that the central bank, which is RBI, is alert to the needs to preserve financial stability in these challenging times. And why these times are challenging? These times are challenging because of COVID-19 pandemic and the subsequent lockdown, which has totally brought the economy to a standstill and it has created a rush for cash. So this COVID-19 induced lockdown, it has led to a rush for cash both among retail investors as well as firms. So this has created a very challenging situation for mutual funds, especially the debt mutual funds. So we'll look more in detail about mutual funds in the key concept section. The editorial further says that in assigning 50,000 crore exclusively for commercial banks to lend to mutual funds, the RBI has made it clear that it wants to tamp down. That means it wants to put down any buildup of liquidity strains. So major challenge that the mutual fund industry has been facing, especially the debt mutual fund liquidity constraints. RBI also realizes that this problem has been made more acute by the COVID-19 pandemic, which has heightened the volatility in the capital markets and also increased the redemption pressures. So there's a rush for cash that we have seen, both by the retail investor as well as by the firms. So what are the reasons behind RBI's move? The editorial says that the immediate trigger for the central bank's move was the announcement by Franklin Templeton Mutual Fund that it was winding up 6 debt mutual fund schemes, and these funds collectively had assets under management of about rupees 26,000 crores. So this has been the trigger for RBI's action, and because RBI realizes that this winding up of 6 debt fund schemes can also have a contagion effect, that this can also spread to other mutual funds and the investor sentiment can take a big hit. So editorial says that RBI has rightly recognized the urgent need to ward off any developing contagion impact from the closure of these 6 funds. Further, it adds that the overall industry-wide asset under management, so whatever fund any mutual fund manages, it is known by this term assets under management, AUM. It further says that the overall industry-wide AUM for debt funds is almost 15 lakh crores, and it was crucial for RBI to reassure investors that liquidity will not be a concern. So what RBI has done, RBI by announcing this 50,000 crore facility, it has tried to assure the investors that liquidity will not be a problem, and if you want to stay invested, you can stay invested. If you want to redeem your investment in the debt mutual funds, you can do that as well. So it is a good move on the part of RBI. The Association of Mutual Funds in India, AMFI, it has also assured investors that a majority of debt fund schemes had invested in superior quality securities and had appropriate liquidity to back their normal operations. Now we often hear this term called investment grade securities or investment grade papers, which can be bonds or securities of any other type. So what are these investment grade papers? So investment grade basically means that their credit rating is high and there is not much risk in investing in these. So this is used as a pointer by the investors as well as by the mutual fund institutions to invest in various financial instruments. And if we talk about Standards and Poor's, their investment grade rating ranges from AAA plus to BBB minus. So whatever financial instruments are coming within this range of AAA plus, which is the highest rating, and BBB minus, this is their investment grade. These ratings are used by the retail investors as well as by the mutual fund industry for investing in such financial instruments. One more thing that we must keep in mind is the higher the rating, the lower would be the interest rate or yield of this financial instrument. So it works on this high risk, high reward principle. So the highest interest rate are provided by what are called as junk bonds or high yielding bonds. Now let us look at the RBI facility, what facility it has provided. So RBI facility that has been provided to the mutual funds industry through the medium of banks. It is a straightforward 90-day repo based lending window from which banks can avail credit to provide loans to the mutual fund. So basically RBI is providing this window to the banks, and the banks are then supposed to lend to the mutual funds. So RBI is not directly lending to the mutual funds, but it wants the banks to borrow from RBI and then lend to the mutual funds. Editorial also says that there are concerns about the banking industry's willingness to expose itself to the credit risk involved in making these fresh loans. So the banks are already having these weak balance sheets, they are fighting this NPAs issues. So banks are already facing a lot of challenges, and at this time they are not having the risk appetite to make further fresh loans. RBI has been aware of this and it has made the norms in a way that incentivize the banks to lend to the mutual fund houses. So how it has done it? So basically it has allowed banks to breach their 25% ceiling on held to maturity investments. So this 25% ceiling which is otherwise there, that will not be applicable when they lend to the mutual fund institutions. And also it has exempted the support extended from banks overall capital market exposure limits. So the banks have a limited capital market exposure limit which is decided by the RBI, that has also been relaxed. Editorial says that it remains to be seen that with the economy still in lockdown and the credit ratings of even relatively well established companies facing threats of downgrade, how willing the banks would be to use this facility provided by the RBI to lend to the debt mutual funds. There remains a big question mark over whether this facility will be utilized by the banks to lend to the mutual funds industry, because same has happened in the case of NBFCs. Now RBI had announced a targeted long-term repo operations for NBFC sector, but the response by the banks to this TLTRO for NBFCs has been very weak. So there is a worry that maybe the same thing would happen with the mutual funds facility also, because the banks are not showing the risk appetite in the current situation the economy is in. Further, it says that the central bank, which is RBI in India's case, they are best placed to maintain financial stability, and RBI has done well to send an unambiguous message. So it has sent a very clear message to capital markets that it will provide them with liquidity to ensure stability and revive credit dispersal by banks. So RBI is doing everything within its capacity to make sure that there remains liquidity in the economy and the banks revive the credit dispersal, because that is very important for the economy to get back on track. So it is very important for the banks to start giving credit again. Finally, the editorial says that the onus is now on the government to step in to complement these measures by taking steps to revive the economy, because ultimately a good financial stimulus is required by the government for the economy so that the economic activities restart, they revive, and whatever pressure that has been created by this lockdown is eased off. So these were all the key points that have been mentioned in the editorial. Now let us look at certain important concepts. In concepts to learn section, we'll look at RBI and mutual funds. Reserve Bank of India was established on April 1, 1935 in accordance with the provisions of the Reserve Bank of India Act 1934. So this act is very important. This we should remember, and the year that when RBI was established. Now, central office of the Reserve Bank was initially established in Calcutta, but later on it was moved to Mumbai. And when it was moved? In 1937. Originally it was privately owned, but it was nationalized in 1949. and now it is fully owned by the government of India. The present governor of RBI is Mr. Shaktikant Das. The functions of RBI. So it implements and monitors the monetary policy and ensures price stability while keeping in mind the objective of the growth. For this, it has a monetary policy committee which meets frequently. Now it regulates and supervises the financial system of the country. It is also the manager of the foreign exchange of the country. It also has the responsibility of issuing the currency. So these are some of the important functions of the RBI, and it also acts as the lender of the last resort. So when banks fail to provide credit, it is RBI that steps in. So this was all about RBI. Now let us look at mutual funds. Recently the RBI has announced a special liquidity window of rupees 50,000 crore to bail out the mutual funds hit by the turmoil in the debt fund segment. So this was what the editorial today was all about. And now let us see what is a mutual fund. So it is a type of financial vehicle made up of a pool of money. So there is pooling of money as well as pooling of risk. It is collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. So mutual funds can be of various types. So there can be a mutual fund which invests in equity. So these will be equity mutual funds. There can be debt mutual funds who invest in debt instruments like bonds. And the present crisis is being faced by a subcategory within the debt mutual funds. And there are also hybrid mutual funds. Now, they are instruments through which you can invest in the shares of different companies that are listed on the stock exchange. So, how mutual fund is operating? So, there is an option where you buy a share of a company directly, and as the prices go up or down, you suffer loss or you gain. But when you do it through a mutual fund, so what is happening? Lot of investors are pooling their money. So, they pool their money, they give it to the mutual fund which is managed by a manager, and then this mutual fund invests in various stocks. So your risk is pooled in a mutual fund. So it is considered to be a safer instrument. But the problem with Franklin Templeton has happened in debt mutual funds. And they were also of a type which was basically in credit risk mutual funds. So credit risk means they were buying securities or financial instruments which were rated investment grade, but they were of AA category. They were not top rated like AAA plus. They were investment grade, but they were having a lower ranking, and that is why they were providing high yield, high interest rate. What has happened due to this economic lockdown brought on by the COVID-19 pandemic? These companies have been unable to fulfill their obligations to the mutual fund, and subsequently, because of this panic in the market, there has been a lot of redemption pressure where investors have been trying to get back their money, and the mutual fund schemes were unable to do that. That is why Franklin Templeton took a call to wind up its 6 mutual fund schemes. Now, what are shares? A share is referred to as a unit of ownership which represents an equal proportion of a company's capital. A share entitles the shareholders to an equal claim on profit and losses of the company. And what is the difference between mutual fund and shares? So when you invest in a mutual fund, your money is pooled and then invested in shares, bonds, etc. of several companies. So if it is an equity mutual fund, then it will be invested in shares. If it's a debt mutual fund, then it will be invested in bonds. So there is diversification, but this is not possible if you invest in shares directly. Because when you invest in shares directly, then you will buy a share of a particular company, company X. But when you invest in a mutual fund, then that mutual fund invests in a variety of companies because it has a large corpus available with it to invest. So it will buy shares of company X, Y, Z, A, B, C, etc. So you have more diversification. That is why in general it is said that if you are investing in shares or if you are investing in shares through a mutual fund, this is safer investment. But then conditions apply and every investment that you make is subject to market risk. So the risk is mitigated in case of mutual funds as your money is invested in various companies. But this does not happen in case if you directly invest in shares as we discussed. So this is an important concept with respect to exam, and we should know what is a LTRO or long-term repo operation. When it is targeted, then it is called TLTRO. Now LTRO is a tool under which the central bank, RBI in this case, provides 1 year to 3 year money to banks at the prevailing repo rate, accepting government securities with matching or higher tenure as the collateral. So to understand this, we should also know about repo and reverse repo. So when RBI is lending money to banks, it is called repo, which is repurchase options, and it is done to provide liquidity in the economy, to boost liquidity in the economy. And in reverse repo, the RBI borrows money from the banks. So it is done to control the money supply in the economy. So this is repo and reverse repo. This is very important from exam point of view. But in LTRO, what is happening? The central bank is providing 1 year to 3 year money to banks at the prevailing repo rate and accepting government securities with matching or higher tenure as the collateral. So what is the aim of this? The aim is to assure banks about the availability of durable liquidity at a reasonable cost relative to prevailing market conditions, and also to encourage banks to augment credit flows to specific sectors. So these are the two main aims of this kind of targeted long-term repo operations undertaken by RBI. Now let us look at what is credit rating. So credit rating is a quantified assessment of the creditworthiness of a borrower in general terms or with respect to a particular debt or financial obligation. And a credit rating can be assigned to any entity that seeks to borrow money. It can be an individual, a corporation, a state, provincial authority, or even a sovereign government. And this has a very significant impact on the investor sentiment. So a credit rating not only determines whether or not a borrower will be approved for a loan or debt issue, but also determines the interest rate at which the loan will need to be repaid. So a high credit rating will make sure that your interest rate of borrowing is lower and vice versa. A sovereign credit rating is an independent assessment of the creditworthiness of a country or sovereign entity. Now the global credit rating industry is highly concentrated with three agencies: Moody's, Standards and Poor's, and Fitch. They are controlling nearly the entire market. So these are important credit rating agencies about which we keep hearing and reading about in the newspapers. In India, there are 6 credit rating agencies registered under SEBI. SEBI is also very important from exam point of view, which are CRISIL, ICRA, CARE, SMERA, Fitch India, and Brickwork Ratings. So this was all about today's editorial. Now let us look at what kind of questions can be asked in prelims and mains. So in prelims, basically you can be asked about repo, reverse repo. So you should be very clear about the definition of these terms and how they operate. Similarly, this targeted long-term repo operations. So what is the RBI's aim in doing this, how it functions? Basic idea you should be having. Then also about debt mutual fund, how they are different from equity mutual funds. Then about RBI and SEBI, what is their function and how they were established. So that is important. And again in mains, you can be asked about RBI's role in providing liquidity to the economy and what are the tools it uses for that. Similarly, you can be asked about mutual funds and about capital markets in general. A question can be asked. Then one can also be asked about the credit rating agencies and how they function and what are the loopholes in their working. So this was all in today's editorial analysis. See you next time with another editorial. Thank you.